Spain becomes the second Eurozone country to shake free from a multi-billion-dollar bailout. And it's breaking records for attracting new investors. But with unemployment on the rise in a country saddled with debt, is it too early to talk of recovery? This is Inside Story. Hello there and welcome to the programme. I'm Shuli Ghosh. After a crippling debt crisis, Spain has emerged from recession and has announced that it's quitting its bank bailout programme. Madrid received 41 billion euros, or around $55 billion, to prop up its banks a year ago. It's now the second country to leave a Eurozone bailout, after Ireland left its programme behind last month. It's being hailed as a success story, but is it? Unemployment remains staggeringly high in Spain, with the latest figures putting it at 26%. Households and companies are still saddled with debt, and the growth forecast for the country this year is well below 1%. Sonia Gallego reports.
Some good news to sing about. Spain's economy is improving. At least that's what some investors are saying. It's finally exited a bank bailout scheme, borrowing costs have come down, and exports are on the up.
Wonderful.
Something the Spanish government is very eager to talk about.
There was a very committed fiscal policy to put public finances into a sustainable basis, and also a strong structural reforms program. And the change in the trend of those imbalances have restored confidence into the economy.
Spain's trouble with its banks have been a thorn in its side. As its own economy nosedived, the sector, in particular small savings banks, looked very vulnerable, especially when it was revealed how high-risk financing built up its property boom. Well, they came here to build, and build they certainly did. Fueled by cheap loans to construction companies as well as home buyers, property prices in Spain rose and rose. But the problem was that this property bubble was being propped up with money the banks had borrowed from international markets and not from deposited savings. So when the 2008 crash happened, the land devalued and many people's dreams had turned to dust. While Spain has exited the bailout scheme, the good news is hardly being felt by ordinary Spaniards. It has one of the highest unemployment rates in Europe. There is also more debt, both public and private, and the banks have clamped down on lending, which some say is hindering any upturn in the economy.
You go directly to the problem of the banks, no? And you don't solve the problem of the household or the enterprise. No? You are not attacking, no, to the problem. You are only trust that the recovery, no, will solve all the problem, no? But the recovery is weak. There is no creation of employment, no? It's a credit-less recovery and job-less recovery.
Spain's government insists it's on the right track, and so far that's being cautiously welcomed by the markets. But it'll take more time until that can be felt right across the country. Sonia Gallego in Madrid for Inside Story.
So lots to discuss. Let me introduce today's guests. We have John Truby, a professor at Qatar University and a specialist in business law, here with me in the studio. In Athens, we have George Kratsos, whose focus, among other things, is sovereign funds and EU regulations. And joining us from Berlin is Diogo Lemos, a visiting scholar at the city's Humboldt University and who worked in Portugal at the height of the economic crisis. Gentlemen, welcome to the programme. John, let me start with you. Spain coming out of a bailout programme after a year. That sounds pretty impressive.
It seems impressive, and it's going to be very appealing for the money markets. It's also going to try and convince the electorate that the Spanish government knows what it's doing, that austerity has worked. Now, this is something that doesn't affect just Spain, but affects all of Europe. So governments across Europe are basing their policies and basing their campaigns on the premise that austerity has worked, that it's been effective.
But it has worked in this case, hasn't it?
It seems to have, but in fact, what we have to remember is that government policies, government fiscal policies, have some impact upon growth, spending or austerity. Whereas the economy really is a beating heart. It expands and it contracts naturally. It happens, we look at history, it's happened every 10, 15 years or so. There's recessions and then there's booms. This causes the growth, and the governments are trying to take the credit now that there is
it's
growth.
been down to austerity, whereas it might
Absolutely.
not be a long-term solution. Is that what you're saying? In the long term, it might be back in recession for Spain.
If Spain have to go back cap in hand to the EU or the IMF, it will be crushing for their government. It will look disastrous. We have to remember that Spain still has crippling high levels of debt, huge unemployment. Actually, today the unemployment figures rose to 26% across the country, more than 50% for youth. They have a GDP to income ratio of something like 95% or more. This is crippling the country, and can they sustain it into the future? Who knows?
Well, that's the big question, isn't it? George, what do you think? Is this a victory for austerity measures?
Well, I beg to disagree respectfully with John. You see, the way I view it, austerity has the effect of incentivizing governments to push forward the reform agenda. Now, let's take Spain as a concrete example. With its banks now recapitalized, lending starts just about to increase, and more money is flowing into the Spanish economy. So as a result, the Spanish government has managed to restore growth within a very difficult economic environment.
But it's
And
still
very
got
importantly, it
massive
did so-
unemployment rate. I mean, 1 in 4 people in Spain are out of a job, and those jobless figures aren't going to come down for some time.
Indeed. It's going to take a while for it to come back. However, I need to point out that growth was only restored now very recently, and this was partly thanks to the bailout scheme. And I should point out that all the progress has been made without Spain's debt spiraling out of control as it was done in other cases. It still remains at a very sustainable level. And with regard to banks in particular, because the Spanish bailout program was addressed to banks, I should point out that
But
it
are
is
the
thanks to
banks
the
back
bailout
on a
program and
sound
the
footing?
conditions.
Are they back on a sound footing?
Well, it seems from it evidently that they started lending out, and more money is flowing into the Spanish economy. So this was, but they are on a sound footing, if you ask for my view, because thanks to the conditions attached to the bailout, Spain now has tougher consumer protection laws. It has stronger supervision over Spanish banks, and very importantly, Spanish banks are facing higher capital requirements. So I do agree that the austerity program has had some very harsh social consequences, but the general developments show that the anti-austerity camp has basically lost the point.
Well, go on, John.
I must disagree with this argument. This is a doctrine that's being pressed right across Europe. The doctrine that austerity measures have worked and they've been the main cause of the return to growth. In fact, the main cause is the natural growth cycle caused by these economic cycles. The return to growth has only been partially caused by the austerity measures, which have helped, satisfy money markets. And these governments who've now had austerity are going to be running on the platform that...
Well, I mean, that's one of the points, isn't it? Austerity measures is being sold as the reason why these countries are coming out of recession, and as a measure which is necessary. These are measures which are imposed by the IMF and the EU when they're lending the money in the first place.
They seem to have helped to a small extent, but it's not to say that austerity is the only thing that would have worked. This has been a crisis which has affected the whole world. Now, if we look at Spain and Ireland, they've had similar experiences. Both of them are now trying to sell the idea that austerity was the solution and should have always been the solution. They're both recovering on paper. In fact, Spain has barely recovered. 0.3% growth last year. The IMF is predicting a generous 0.8% growth this year. Ireland has recovered on paper largely because of its tax haven status. It's got very low corporate tax, which is encouraging international companies to set up tax avoidance schemes which don't actually benefit Ireland, don't actually benefit the Irish people, but which make its balance of trade and figures look very attractive.
Well, let's bring in Diogo. What's your view on this, Diogo? Because George is saying that, lots of investment is flowing into Spain. Spain has managed to get its affairs in order. It's managed to do it without its debt spiralling out of control.
Right. Well, I take the middle position. I agree with some of what John said and some of what George said. So I think that George is right. austerity helped to stop the debt from spiraling out of control, and I think that was an important result in the short term for the peripheral economies. And as we can see, the borrowing costs for these economies are now dramatically decreasing. So it seems that in that sense there is some measure of success. However, as John is pointing out, austerity has failed to prove sustainable policy in promoting economic growth, and with Spain unemployment remaining so high and the same in Greece, and the debt levels also remaining very high in these countries, it's hard to see how austerity is going to promote economic growth in these economies. And then we also have to think about the long-term social costs of austerity economic policies.
Okay, hold that thought, because I do want to talk about the social costs. I want to get an idea over to our viewers of the strength of feeling that still exists in Spain over the country's financial crisis. Take a look at these. These are demonstrations in Madrid. They were among 46 nationwide protests over something seemingly insignificant: local government plans to convert a street in the northern city of Burgos into a tree-lined boulevard. Now, the cost of that is reported to be around $11 million. This is in a city with more than $680 million of debt. And this issue has become a symbol of resistance among protesters who still blame state corruption for causing Spain's economic crisis. Diogo, just to go back to the issue of social hardship. I mean, the problems may be financial, but the effect that they're having is extremely political. I mean, people are calling for a revolution against their governments. They're turning away from mainstream parties because of the cutbacks and the hardships they've had to endure.
Exactly. I think that one of the things we have to remember about this crisis is that at least Portugal, Spain and Greece are all quite recent democracies, and their institutions are still consolidating. And one of the marked effects of the economic crisis has been a loss of faith on national and EU institutions. Now, in national politics, of course, one of the main problems in these three countries is corruption. And I think there is a lot of dissatisfaction among the common citizen that they see their pockets being targeted by politicians, and they don't see politicians adopting measures to curb privilege, to curb corruption, and etc.
Well, I can see George had something to say about that. What do you say to that, George?
Yeah, if I may add something, is that the basic question is how exactly do we measure the effects, and more importantly, how do we measure the success of austerity? Is it simply exiting a bailout program as Ireland and Spain did, or is it establishing a workable governance model? Because in my view it is a little bit of both. And I'm not denying that austerity has had some intense social cost, but the available evidence shows that the general program, the wider program, is heading to the right direction. Just Spain and Ireland are both out drawing funds from international markets at very favorable terms. Unemployment seems to be dropping in Portugal, and in Greece similarly it's gotten under control. Very importantly, also in Greece this year the recession is expected to be ending. So overall, it seems to be heading towards the right direction.
Okay, well, George, let's just remind our viewers of all those issues that you've spoken of there, because in all, 5 Eurozone countries needed financial support from international lenders. As we've been saying, Spain negotiated a $125 billion deal to bail out its banks. In the end, it only needed around $50 billion. Ireland was given $113 billion in 2010 as part of its austerity package, and in December it became the first country in the Eurozone to leave its rescue programme. Portugal received $116 billion in 2011. It's hoping to end its bailout programme later this year. Cyprus avoided a collapse of its banking centre with a $13.5 billion bailout. A first instalment was paid in May. But a bit of a different story in Greece. The government has received 2 bailouts totalling more than $300 billion. It may yet need a third. John, when we talk about the future of the Eurozone and whether it's finally making a recovery, it just doesn't look like it's happening for Greece.
Greece continues to struggle. They were terribly managed for years and years and years, and they, as Diogo has pointed out, had and still have terrible levels of corruption, people not paying their taxes, this kind of thing. This is evident not just in Greece, but it's in Spain and it's elsewhere across Europe. It's endemic, and until these problems are addressed properly, the system can't support and continue to pay people for their long-term social welfare.
So what is the reality here? Because there is a rush to buy government bonds right now, particularly in countries like Spain and Ireland, where they've come out of the bailout, low interest rates. Investors seem very keen to buy up that government debt. So there seems to be an air of confidence in the way Europe's going. Is that correctly placed or misplaced?
The exit from the austerity package, from the bailout package, is a big success. It makes, for the government politically and for the money markets, it makes the country look like a more attractive place to invest. Yesterday, Spain sold $10 billion euros of debt.
Yeah, they broke a record.
But this doesn't mean that they've recovered at all. In fact, during the recession, during the last 5 years, they've curtailed lots of their infrastructure programs. They had a huge solar power program. They had a huge railway program. They've had to cut all of this. Well, they didn't have to, but they chose to as part of their austerity measures. This has caused huge unemployment. The youth is lost. It's the same thing in Ireland. 300,000 people left Ireland.
They're getting investor interest. They're getting money into the country. Surely that's a good thing.
It's a good thing, of course, but this argument that austerity is the only way to solve the problem is not accurate. It's deceptive. Actually, we're being deceived as an electorate. We're being told that austerity is the solution, is the only solution. This is the same thing we were told in the 80s. In fact, growth is a natural phenomenon. Yes, government policies can help, but as I said, the economy is a beating heart. It contracts and expands every 10, 15 years. This would have happened anyway.
Well, let me get George's reaction to that. So the idea that just because government bonds are suddenly becoming popular again and investors seem to be regaining their appetite for risk, that doesn't mean there aren't still problems. And in fact, it might be masking problems in the Eurozone.
Certainly, government bonds is just an index of how things are moving. The important thing is to push forward the actual reform agenda. And without the effect of austerity, governments wouldn't be same as incentivized to push forward for reforms. For instance, in the case of Greece, according to an OECD report, Greece has had the highest number of reforms worldwide for 2013. So it's important to see where our country is coming from.
But it looks like Greece is going to be going into deflation, which is a technical term, but it means basically falling prices, which are going to affect wages and living standards and put more pressure on debt. That's a bad thing. Surely. In Greece, there are still difficulties to get through, but the progress has been immense. But I'd like to respond to what you said by giving you an historical example concerning my country, Greece. Greece has defaulted already 4 times in the past 200 years. And here I'm referring to an era when there was no Eurozone to blame for, no Troika to use as a scapegoat. In fact, the responsibility rested entirely upon us. So how would you address the fact that Greeks had to endure some harsh austerity measures back then? In fact, what I'm trying to say is that many people tend to see today austerity as the root of the problem. In fact, I think it would be more accurate to see it as a consequence of the crisis. Okay, Diogo, just on the subject of whether we should be optimistic about Europe or not, where do you stand on that?
Well, if I can go back to George's comments about the pressure that austerity is putting on Greece's policymakers to adopt certain reforms, I think it's not really an ideal to expect the country to adopt certain reforms because of external pressure. I think countries should aspire to do the reform on their own and based on a democratic process. So if we're pushing this issue to outside the borders, we're not really promoting the autonomy and independence of the country.
But do you agree that I mean, George seems to be saying that Greece is going to face a better future at the moment. Other analysts are saying Greece is likely to face a lot more hardships because any further loan agreement is going to depend on further cutbacks.
Well, I think Greece is definitely better now than it was, say, 2 years ago at the height of the sovereign debt crisis. However, another thing is saying, well, is this the path for Greece to solve its problems? Well, I don't think nobody believes that at this point.
John, Mario Draghi, the head of the European Central Bank, has been very restrained about how Europe is looking in terms of future growth. He was asked at a recent news conference whether it would be premature to declare victory, and he said, I would be very cautious about saying that, very cautious indeed. It does look as though there are still rocky days ahead for Europe, and people might be talking about growth, but actually it's going to be a very difficult journey.
We've got a long way to go across Europe. We need to stop thinking short term just to win elections. We need to start thinking long term. Long term, we need to start planning for the next recession. It will happen again, it always does. We need to start fixing the problems. We need to understand the markets better. You know, we've got to recognise that there's trillions of dollars traded every day on the markets. Cutting a few million or even billion dollars in social welfare, it's a popular headline. Does it work? Possibly, we'll see. But we've got a long way to go, and we need Europe to have a more united approach.
What option has Greece got? Because Greece may now need a third bailout. If you don't give that to Greece, what happens to Greece? Surely there's no alternative.
Greece has failed again and again to privatise all of their state assets. They had very strict conditions that they've not adhered to. They, of course, need to continue borrowing, and they will have to keep this line of credit open. They shouldn't take the exit strategy that Spain took.
So do bailouts work?
They're necessary for some time. Whether Spain was right to leave their bailout so early, we'll have to wait and see.
Diogo, you're Portuguese. Portugal is talking about coming out of its bailout programme. Is that the right thing to do?
Well, I think that the public discussion at the moment is really not about whether that is right or wrong, but what options do we have? And at the moment, it seems that we can't really have a clear exit as Ireland did, because we still need to meet our financing needs for 2014. And so the most likely outcome will be a precautionary credit line for the rest of the year and for the next few years.
Indeed. And George, I mean, one can understand why countries want to get out of bailout programs as fast as possible, because they want to inspire confidence in their economy, don't they? Because that's the very reason why money comes flowing in. Confidence is half the battle.
Yes. Well, unfortunately, a serious factor that determines whether countries exit the program or not is the debt levels. And unfortunately, as debt level stands at the moment in Greece, are not really considered sustainable. So what I'm foreseeing is that probably another haircut on Greek debt will be affected very soon, possibly this time on the debt held by the official sector, meaning Greece's Eurozone partners. But there's more than this, because the way I view it, measures need to be taken at the European level as well. I mean, we have already come some way into establishing a banking union, which there's been some progress, but there's still more to be done, for instance, by ensuring that the European Stability Mechanism lends directly to banks and not via national governments, and then eventually look seriously into the possibility of establishing a political union with real fiscal consolidation. These are also aspects and factors that need to play out in parallel with the reforms carried out at the national level.
Gentlemen, thank you very much indeed for joining us for today's discussion. Very enjoyable. John Truby in the studio, George Kratzis in Athens, and Diogo Lemos in Berlin. And thank you for watching at home. You can follow us on Twitter at AJ Inside Story. Tweet us any thoughts you have on today's programme. Until next time, from me, Shuli Ghosh. Bye for now.